Welcome back to the channel, everyone. Today, we're diving deep into the precious metals market because some major things are happening that you need to know about. Let's start with gold. For the first time in history, gold has closed above the $5,000 mark on its weekly chart. Now, before you rush to check the spot price and get confused, let me clarify. I'm not talking about US dollars. I'm talking about the Canadian dollar. Gold closed at 5,036 Canadian dollars per ounce. So why is this a big deal? It's a huge psychological barrier that's just been broken. This isn't just a random spike. It's a solid weekly close, signaling a potential new phase for gold's valuation in currencies other than the US dollar. This is a pattern we've seen before. Gold hits all-time highs in other currencies first, the Japanese yen, the Chinese yuan, the Indian rupee, before it finally breaks out in US dollar terms. The Canadian dollar is just the latest domino to fall. It tells us the underlying strength of gold is real and global. Now, you might see headlines from mainstream media saying things like, "Gold pulls back amidst profit-taking." Don't be fooled. These headlines are often misleading. They focus on short-term price fluctuations in US dollars, completely ignoring the bigger picture of gold's performance against a basket of currencies. When you see gold making new highs in country after country, it's not just profit-taking. It's a fundamental revaluation of the metal against fiat currencies that are losing purchasing power. These headlines are designed to make you think the rally is over, but the data suggests it's just getting started. Adding to this complex picture, China has introduced new enforcement rules regarding paper metals. Starting August 1st, banks will face stricter scrutiny on how they handle paper gold and silver contracts. This is a massive development. For years, there has been a huge disconnect between the amount of paper metal traded and the actual physical supply. China seems to be cracking down on this, potentially forcing a reconciliation between paper and physical markets. If this rule is enforced strictly, it could be a game changer, removing a lot of the artificial price suppression we've seen in the past. It is a clear signal that China is taking control of its domestic gold market and values price discovery based on real supply and demand. While everyone is focused on gold, let's not forget about its little brother, silver. The situation with silver is, in many ways, even more critical. The registered silver inventories at the COMEX are currently sitting at just over 30 million ounces. To put that in perspective, that's less than $1 billion worth of silver. In a world of trillions, that's an astonishingly small amount. This isn't some deep, hidden vault. It's the available supply for delivery against futures contracts. The shelves are practically bare. Why is this so important? Because silver isn't just a monetary metal, it's a critical, strategic, and industrial metal. The demand is off the charts. It's essential for solar panels, electric vehicles, 5G technology, and countless other high-tech applications. Unlike gold, most of the silver that gets used in industry is consumed. It's gone forever. It doesn't get recycled back into the market in the same way jewelry or coins might. Governments and major corporations are starting to realize that a silver shortage could bring their green energy and technological ambitions to a screeching halt. A country can't build out its solar infrastructure or its EV fleet without silver. It's becoming a matter of national security. When you combine this insatiable industrial demand with the incredibly low inventories and the potential for a monetary panic into physical assets, you have a recipe for a price explosion. The disconnect between the paper price and the physical reality of silver is more extreme than for any other commodity. So, to wrap it all up, we're seeing gold break historic levels in major currencies, China is tightening its grip on the paper market, and silver inventories are at dangerously low levels amidst a surge in strategic demand. The signs are all pointing in one direction. It's an exciting time to be paying attention to this space. Thanks for watching, everyone. If you found this analysis helpful, make sure to hit that like button and subscribe for more updates. We'll see you in the next video. Here's the key imbalance. China produces only about 13% of global silver mining output, but controls roughly 70% of refined silver processing. Mining doesn't matter if you can't refine. No refined silver means no AI expansion, no advanced weapons manufacturing, no high-performance electronics. This is why analyst David Morgan recently warned that the US government may eventually stockpile silver, not as an investment, as a strategic necessity. He also highlighted a historical pattern. Roughly 90% of bull market gains happen in about 10% of the time. His estimate? The next 12-18 months could define the entire silver cycle. That's what parabolic phases look like. Here's one of the most overlooked signals. Gold ETF holdings are still below their 2022 highs. Let that sink in. Back in 2022, gold was around $1,900. Today, it's over $5,000. Price nearly tripled. Yet ETF investors reduced exposure. That tells us retail isn't here, institutions aren't here. Who's buying? Central banks. They're taking physical delivery quietly while paper holders exit. That's not mania. That's early stage revaluation. Big players accumulate before the crowd notices. Now zoom out. The US just ran a $697 billion deficit in the first 4 months of the fiscal year. That's the third largest on record. Government spending hit about $2.5 trillion. Revenue came in around $1.8 trillion. Net interest alone is now running near $1 trillion annualized. And here's the critical number. Over the next 12 months, roughly $9.6 trillion in US government debt matures. That's double what rolled before the 2020 crisis. So the Treasury must refinance $9.6 trillion, fund new deficits simultaneously. While interest costs explode, that's not normal refinancing, that's structural risk. You can't fix that with rate cuts. That's why gold doesn't care about headlines anymore. It cares about math. Let's summarize what's happening. Gold just closed above $5,000 for the first time ever. China banned rehypothecation and enforced physical delivery. Shanghai silver trades at a $9 premium to Western paper. Inventories are thin. Governments are waking up to strategic metal shortages. ETF holders are selling. While central banks accumulate debt and interest costs are accelerating, media narratives are increasingly unreliable. This isn't a trade. This is a system transition. Markets can pull back. Silver can stall. Gold can consolidate. Corrections happen. But structurally, the paper suppression model is cracking. Physical demand is asserting itself. And sovereign balance sheets are quietly voting with metal. This isn't about fear. It's about preparation. Invest with logic, not headlines. Because the financial system isn't breaking overnight. It's being rewritten, one settlement at a time.